in case you want to buy your favorite stocks and you don't have enough money in your trading account, you can still avail the facility of margin from the broker. It does not come free of cost. There is certain interest that they charge for it. This interest, depending on the counterparty, may range from anywhere between 9 to 18%. Investors who typically do swing trading and BTST, I think it's an important instrument for them. This is not specifically designed for the long-term investor.
How does an investor enable or access MTF facility if they have to?
So from an investor point of view, I think it's a fairly simple thing.
Can you buy stocks without having the money for it? Well, you can. Your broker can lend you the money to buy the shares, but there are some costs to it, as well as there are quite a few risks that you should be aware of when accessing margin trading facility. In today's episode of Mint Money Talks, we are joined by Trivesh Dinesh, who is the COO of Tradejini, to tell us more about this. Hi Trivesh,
Hey,
welcome
Jayesh.
to this episode of
Thank
Mint
you
Money
so much
Talks.
for having me. I think it's a great topic to discuss and get deep into. It's really picking up now, so I think it's the right time for all the viewers to know what really happens in MTF and how does it all go about.
Right. So Trivesh, tell us, how does MTF work? What are the sort of nuts and bolts there?
Yeah, of course. So MTF, it stands for Margin Trading Facility. It basically means that in case you want to buy your favorite stocks and you don't have enough money in your trading account, you can still avail the facility of margin from the broker. So the broker, either through his own funds or through funds borrowed from NBFCs/banks, can loan this money to potential clients who would like to buy certain stocks using leverage. Now, what is leverage? Leverage is equivalent to a loan, but in this case, the loan is not from a bank or from an NBFC, but from the broker. So the broker is going to loan out X amount of money against a certain amount of either stock as a pledge or certain cash, the so-called down payment. So if there is a certain amount of down payment that the client is willing to do, say 20 to 25%, typically that's the range, then the balance 75 to 80%, the broker is willing to fund.
Right.
Obviously, this does not come free of cost. There is certain interest that they charge for it. This interest, depending on the counterparty, may range from anywhere between 9 to 18%, depending on the tenure of the loan, the quantum of the loan, and also on what assets are you taking the loan on, whether it's a more riskier bet, it's a less riskier bet. So there are a lot of things that go into consideration, but there is an interest element.
Right. I think the margins typically, from what I was checking, are 25, and on the higher side it could even go up to 50%, because if those securities are
less liquid.
Yeah.
So typically most platforms allow you 4x leverage.
Okay.
4x means that 25% is funded by you, and the balance 75% is funded by the broker.
Right.
There are some platforms who also do 5x, which means that 20% is what you have to get. So assuming you have to, say, pick up security A, which is 1,000 rupees, and you want to pick up 10 securities of it. So for 10,000 rupees of purchase, you have to only put 2,000 to 2,500 rupees, and the balance amount is funded by the broker.
Right.
It is to note that this is only for the equity cash segment. It is not for the FNO or the intraday or the MIS order type.
Right.
It's only for.
And on the higher side, it can go up to 50% initial margin requirement.
By like you said,
investor.
A lot of securities, lot of small cap companies where the liquidity is very low. The risk that the broker is taking on those securities is extremely high.
Right.
So to manage their own risk, and as part of their RMS policy, that is risk management system, they will cap the overall limit that they can give and also block per security leverage. So a lot of securities may actually only be 50%. That means that you have to fund 50% and only get a loan for 50%. So there are those stocks as well which have a lower margin capability.
Okay, got it. And Trivesh, how does an investor enable or access MTF facility if they have to?
So from an investor point of view, I think it's a fairly simple thing. If you have a trading and demat account with the broker, and the broker has an MTF facility already approved with the exchanges and has their own backend systems already up to date with respect to MTF. It is just a segment enablement for a client. What are the segment enablement? Saying you just go to your respective back office, enable an MTF as a segment like equity cash, NSE BSE cash, NSE FNO, NSE commodity are segments. NSE MTF is another segment. So just go segment, enable the segment, and you're ready. After that, there are certain terms and conditions, obviously, which will detail out how much of loan are you eligible for, what is the interest rate that is going to be there, what happens when these securities have a dip in the market. So what can the broker do in terms of their respective RMS? Can they sell off these shares? What are the safeguards for you in terms of if there is a run on the broker, what happens, etc. Those are the things which are detailed out in the document, which you eventually sign through an e-Aadhaar signature or any online signature. You sign, and then you are all set to go. You can use MTF from day one.
Right. And can you also explain us how the interest is charged? Is it from day zero of sort of day one of utilizing the amount, or how can you explain the calculation of interest?
And this
cost?
is a very important thing because a lot of people will not understand the nuances because it has a lot of computational from any broker saying how much is the margin to be deployed, what happens when there's a peak margin computation, what happens when the stock falls, what happens when the stock rises. So for a client, it is simple saying that today if you have used 1 lakh of the broker money, from today there is a interest that is going to be charged on a daily basis. Like I said, the interest could be 9 to 18%, anything in between. So that divided by 365 days is the per interest cost. So
per day interest cost.
Per day. So this interest gets charged to you on a daily basis in your ledger and in your reports.
Right.
Two important things. One, like I mentioned, it's only for equity cash.
Sure.
There is something called as BTST trades, which is the buy today, sell tomorrow trade. So investors who typically do swing trading and BTST, I think it's an important instrument for them. This is not specifically designed for the long-term investor because if you are picking up long-term investments using an MTF facility, you are paying quite a large sum in terms of interest for something which you want to hold for a perpetually long time. This is done typically to capture those short-term moments where you are very bullish on a particular stock for a few days, few weeks, few months, and you want to capitalize that with a larger sum of money. You want to take a larger risk, larger bet. So it is to note that this is typically used by those swing traders and BTST traders only and not the long-term investors. Second, why this product actually came into existence is because there is already leverage on the FNO side. You can take a 5x. Already most scripts option contracts have a 5 times leverage at least. And intraday also has a 4 to 5x leverage on all the stocks. So the only product that didn't have leverage was the equity delivery. And that's where this got introduced a long time back in the market. But fun facts, in 2020, the entire margin trading book was about 7,000 crores, which is like a drop in the water, a drop in the ocean, sorry. Today, that in September of 24, that had reached to a massive 85,000 crore loan book.
Right.
Now, from September, all of us know October, November, December have been a very lean period for the market. It has seen some drawdowns in terms of a fall in the market. So that loan book now has come from about 85,000 crores to somewhere between 70 to 75,000 crores. So there is a 14 to 15,000 crores sell off. And why this happens is because most stocks that would have been pledged for the MTF have all been reduced in value. So when that happens, the margin calls would have increased from the broker side.
Right.
And when this happens, people tend to get scared and they wouldn't want to utilize more of MTF in these scenarios. So MTF, the loan book and the markets go very hand in hand.
Can you talk more about margin call?
Of course. So margin call is typical to your, in simple words, the loan recovery agent who comes knocking at your door saying, please pay up the money. Margin call is that from the broker. Now here, because these are mostly tech-enabled platforms, these are all done through notifications, email, WhatsApps, a specific pop-up in your trading application saying there is a shortfall in your trading account. You need to bring up this much more money or pledge certain more stocks to continue your MTF facility. And in case you don't do, then the broker has the right to sell off your stocks.
And there is a small point. I think if you are, there are obviously two options. One is cash collateral, like we were talking earlier, basically the cash lying in your broking account, and the other is the shares lying in your demat account.
Correct.
Both can be collateralized for MTF. But if you're using the second option, that is what we are talking about, the share pledge option, you also need to approve the pledging on the same day by 7 p.m. I think that's
correct.
also
So in case you want to pledge,
otherwise again the broker can sell those shares.
the brokers can sell. So like you rightly said, and it's an important point for everyone to know, saying if you're going down the pledging route, which means that you want to pledge your own stocks to avail MTF facility, the day you want to pick up the MTF facility, on that day before a certain time, 7 p.m. is for certain brokers. There are a few who have 5, few who have 6, but the maximum cutoff is 8 p.m. So anytime before that, if the securities which you want to pledge are not pledged to CDSL, there is a link that comes from CDSL. You need to press on that link and make sure that your pledging request is complete. If that is not done, in essence, you have not given any security to the broker. So that means that now the broker has funded you naked, which means without a security, there is amount that has gone into your account from the broker. And the next day, he has all the rights to sell off whatever that you have purchased using the MTF at whatever value, and make sure that he is recouped his money along with interest. And that is definitely allowed. And second, in case you don't pledge the stocks on the same day, it can also get converted into a delivery trade, which means that the broker may request you to bring up the entire money into your account in form of cash, which is a nightmare. So all the clients need to be aware, saying that they need to make sure that all of their pledge requests are complete on the same day, because otherwise it's going to become a real hassle for the clients to get the money into their account.
Right. And are there any other costs involved, like for pledging and unpledging of these? Is there a cost charge?
There
by
could
brokers?
be a couple of other costs. One is obviously the interest cost that is obviously there, that we discussed. Second, the more common cost is the brokerage. Obviously, the broker will charge per order. That could, for a discount broker like us, it's $20, and most other platforms also will be in the similar range, 20% or 0.03, 0.04% of whatever is the traded value, whichever is lower. And the third is also the pledging unpledging charge. So, and that to note is per script.
Right.
So if you're pledging 10 scripts, the price could be between 20 rupees to 50 rupees per script. So that depends on every platform. So this cost is an addition to whatever you're paying as interest and as brokerage. This is the pledging and unpledging cost, because there is a facility that the broker is providing to make sure it's a seamless process, online, completely digitized, etc. So there is the cost. So these are the typically 3 costs that are there, which is upfront. After this, there is also, in case that you don't maintain balance in your accounts, or if there is negative balance in your account, the client can, the broker can sell off your securities, and in case that there is a shortfall in your account, then that amount of negative balance will continue in your account, which can also have an interest on it.
Okay.
So the negative balance may have another set of interest computation on that amount.
Okay.
It's a rare case, but it is possible.
Okay. Okay. And I think the statutory securities transaction tax at
Those
the
are,
time,
those are quite a lot.
Yeah,
so
when
those,
you
the
sell,
government charges, GST, stamp duty, STT, SEBI transaction
no,
fee.
I mean the broker will obviously recover that also when you sell the stock.
Both at buying and at selling.
Yeah.
So you collect all of these charges, and those need to be deposited to the respective government agencies. Whatever happens as a pass through, we are only a conduit in all of this. We only do the collection on behalf of all of these agencies and pass that on to those agencies.
So Trivesh, 2 things. What are the risks for the investors?
Yeah.
And after that, if you can tell me about what are the systemic risks that MTF can potentially have for the broking industry, as it were, and even to some extent for the markets.
Sure. So before getting on the risk side, so a couple of things which is good for an investor from an MTF standpoint is obviously availability of balance, liquidity. So in case you are extremely bullish on a particular stock and you really want that money without going through the entire documentation process with a bank, with an NBFC, and by the way, the banks and NBFC also have a cap on how much you can take as borrowed funds in form of LAS, which is loan against security, or from an NBFC. There is a limit that these guys have put, and with both the NBFCs and banks, the haircut is 50%. which means that 50% of funds you have to bring in your own, which is very different for an MTF. In MTF, it can go even up to 20%. So for the client, it's very beneficial. So that is one important point. Second, obviously, there's almost no documentation for an MTF. And third is convenience, because it's all sitting in one platform. There is no other platform you need to deal with. The money comes into your account. And what people don't know, which is another important point, is in an MTF, when at the time of selling, now technically the stocks are, say, stock A is the one that you bought through MTF. Now, if you have taken the same stock as a loan from an NBFC or a bank, which is a LAS, before selling off the stock, you have to actually bring in the money equivalent to the sell value before selling and repay off your loan to the NBFC or bank, unpledge the securities with CDSL, and the lien is created on the bank. So you have to unpledge the lien, and only then you're allowed to sell.
Right.
So this means that the client has to bring in the value of the funds that he wants to sell before actually selling and repay off his loan. But in MTF, it doesn't work that way. You can sell off your securities at the time that you decide to sell. And because this is earmarked to the broker does the collection on behalf of the client and ensures his balance is repaid and the interest is repaid, and then the balance amount, whatever the profit or the loss, is going to the client. So that's another very important thing that needs to be considered for the client. So those are typically the advantages that the clients have in terms of MTF. But the risks, like you rightly said, are the more important ones to discuss. One, obviously, leverage is always a two-edged sword, because on one side you are constantly paying interest, and on the second side, if the markets are not going in the direction that you are expecting it to, you also have to bring in additional capital at every single point, the margin call that we are discussing. So it's a two-edged sword. So leverage sometimes is good, but if it is not done consistently well in terms of planning and in terms of the risk that each client is willing to take, it can really lead to a lot of other problems. So the most important point is that leverage brings a lot of other risks. Second, because you are taking leverage on, sometimes you take a lot more riskier bets because you think it's not finally my money, it's okay, let me take a riskier bet. And those riskier bets sometimes don't pay off. So you're looking at a significant drawdown because you have that access, so easy access to money. You sometimes take a lot more irrational decisions than what you would have done if it was your own money. And the third more important thing is that from a systemic risk point of view, because the broker is finally giving out these loans and there is constant loan borrowing from the client and giving by the broker. If there is a drawdown in the market, there is something like a COVID, there's a 20, 30, 40% dip in the market in 5-10 days, in a week's time, there is a high chance that there could be a run on the broker as well, if it is a smaller broker. Obviously, the larger, more capitalized brokers will have a very small portion of their capital in MTF, so that the risk is very less. But the smaller, more traditional brokers who have a smaller overall capitalization but a very large MTF book, they carry that big risk, wherein on a lot of these platforms.
Right. But Trivesh, like, the example you gave earlier, and we also kind of touched upon it, there could potentially be a scenario for the investor that if a leverage trade, goes against him or her, he or she can even lose the pledged shares along with paying interest, and along with, obviously, you lose shares that you got from borrowed capital.
That's a very potent risk, just because if you have borrowed 1 lakh rupees, example, from the broker, which means that you would have typically paid 25,000 rupees and balance 75,000 rupees is borrowed from the broker. And that stock tomorrow, for some reason, there is news, because markets react to news, markets react to events, market react to other scenarios. And if there is a reaction in that particular stock to the tune of 20-25% on day 0, day 1, you are in for trouble, for sure. One, your securities will get sold, whether you like it or no. You will have to pay interest for the day that you have bought the securities, and also for the day when there was shortfall, because there would have been a margin call, you wouldn't have been able to bring the money immediately. So there will be that additional interest that you will have to bear now. So one, you are bearing interest. Second, you are bearing the additional interest for not bringing in the margin call. Third, the securities that you liked will now be sold without your permission also. In the sense, obviously, you have permitted them through a DDPI process, and you have to ensure that DDPI is activated in your account.
What is DDPI?
So DDPI is a demand debit pledge instruction, which means that you have given the instruction to the broker saying you are allowed to sell my shares.
Okay.
It's like a power of attorney in all its aspects. It's now called DDPI for the broking fraternity, where the clients give the permission to the broker saying you are allowed to sell my shares. You don't need a PIN for every sale that you have to do. So DDPI for MTF is a compulsory. So that's another point to note. So there is definitely this risk of both your shares going away, you needing additional funds and paying up a huge interest on the borrowed funds in a very short period of time. So it's extremely tricky and risky, I would say, for somebody who doesn't really understand. A lot of the platforms have started speaking about this being for the early stage investor. I don't believe in that. Because for me, MTF is for somebody who really understands the market extremely well. Because for a guy who's a beginner in the market, giving him this access saying that come and borrow without the person even knowing the markets, how it works, how it fluctuates, it's an extremely risky thing to give it to their hand.
A lot of brokers have been, branding this as, buy now, pay later kind of a scheme. So
that's the worst thing that could happen to the industry, because if you're looking at investor protection, which has been the theme of the regulators also for the last 4 to 5 years, and we've seen the regulations to support it, saying investor protection is the theme. This MTF as a function is counter that theme, because you're giving more leverage to clients to take more riskier bets without them actually having money. The point of capital markets to begin was to enhance savings and give some returns on their savings. But now it has all moved to making a quick buck, becoming this overnight millionaire, making that irrational decisions, which is not in line with the investor protection theme. So having this buy now, pay later, like you rightly said, and it's a very dangerous thing. Obviously, a lot of brokers didn't go through the MTF route. Like I was saying, the numbers have significantly risen in the last 3-4 years, I would say, not before that. It's the post-COVID, maybe from 2022 to 2024 is when we've actually seen the expansion in the loan book. That's because of obviously the bull market that we were all part of for the last 5 years. It's been an exceptional run in the markets. Most people didn't anticipate something like this, especially given how COVID impacted one of the largest countries in the world, and we were supposed to be hitting rock bottom after COVID, but we bounced back. Retail India bounced back, corporate India bounced back, and we've seen a bull run. And because of the bull run, the MTF book also has exponentially grown. But promoting this, advocating this as saying that it's for all the early stage investor, come leverage, start buying stocks, is not something that definitely we advocate ourselves with. And we've been a little away from this MTF facility ourselves also, by the way. So there is certain risk for the clients, definitely.
Right. Great. Thanks, Trivesh. Thanks a lot for joining us today and sharing all those insights.
Of course. Thank you, Josh, for having me. I think it was such a interesting and healthy discussion that we've done, and I think I hope that all the viewers are able to get a sense of what this facility is, and probably even utilize it given their risk appetite that they have. They should probably look at utilizing this facility with their respective platforms.
Right. The operative word is risk appetite, right?
It's important. The risk appetite is an important word, so they should definitely consider that before making a decision.
Sure.
Yeah.
Thank you, Trivesh. Thanks, viewers. That was all the time we had for today's episode. For more such interesting content, keep watching Mint.